If you have a 700 credit score or around a 700 credit score, in this video, I'm going to show you two things you can do that can save you thousands of dollars to help you get the best mortgage with your credit score. Now, some quick benefits of having a credit score around the 700 range is that number one, you likely can qualify for a conventional loan. Conventional loans tend to be best for people who have a 680 credit score and higher. And of course, as your credit score goes up, the better interest rate you'll get. And I'll show you a chart of actually how that works. And then often, sellers prefer conventional loans over government-backed loans like FHA, USDA, or VA. Even though those are great loan options, sellers tend to prefer conventional loans because they have less appraisal requirements, and they have a reputation of closing faster than other types of loans. So if you're at this credit score range, it's very likely that you can go ahead and move forward with buying a house and getting pre-qualified for a mortgage with this score. But I want to show you some tricks you can use to get the best mortgage with your 700 score. Okay, so this is what I call rate hacking. So basically what happens is conventional loans the rules are set by Fannie Mae and Freddie Mac. They're the two big players that create rules for conventional loans. And the way that they create the rates, what your rate is based off of, is what's called a loan level price adjustment, an LLPA. So loan level price adjustments can be a little bit tricky to understand, but basically what they do is they increase the cost of the loan if the loan is more risky to the lender. So the more risk that your loan has, the potential higher rate you're going to get. But loan level price adjustments work in cost rather than rate that most people are used to. Basically, the way this works is that the more risky your loan is, there's going to be upfront cost to the loan. So when you get a mortgage, there's going to be kind of a set rate on the back end. And then the more risky it is, let's say that you have a lower credit score or a lower down payment, that might add cost to the loan with that set rate. Now, instead of lenders charging you that upfront cost, normally what they do is they increase the rate so you get what's called a par rate, meaning that there's $0 cost to you and you get the rate at a $0 cost. However, you could pay those out-of-pocket costs if you wanted to get a lower rate. So I'll explain this a little more. It should become a little bit more clear as you see some examples. Now, because these loan level price adjustments are public, meaning you can see them whenever you want, we can actually hack them in a way. So this is the Fannie Mae loan level price adjustment matrix. All I did to search for this was search Fannie Mae LLPA, and this will be the first thing that pops up. And so if we scroll down through here, what we'll see is actually a chart of different down payments and credit scores. And then right here is the loan level price adjustment. Now, keep in mind, this is not the rate, this is the cost. And I'm going to show a different chart that I have available to you that's going to make this way easier to understand. I just want to show you how the raw data here works. Okay. Now, some other risk factors in mortgages are things like if you get an adjustable rate mortgage, you can see the difference in cost to your loan here. If you have a condo, an investment property, second home, manufactured home, 2 to 4 unit property, high balance fixed rate, high balance ARM, and then any subordinate financing, meaning like a second mortgage. Now, one interesting thing, we're going to scroll through a couple different ones here, is that there are what's called loan level price adjustment waivers that most people don't know about. So that's for home ready loans. So that means if you have 80% or less of the area median income, if that's what you make per year, you usually can qualify for a home ready loan. It also has lower mortgage insurance. So it completely waives having these costs at a higher rate with your mortgage. And then also, if you're a first-time buyer with qualifying income less than or equal to 100% of the area median income, then you get a loan level price adjustment waiver as well. So you don't have to know this specifically. This will automatically be applied to a loan if you qualify for these, but it's something interesting to keep in mind here. Now, I know those charts are kind of confusing. So what I did is I turned it into a site that you can go to, winthehouseyoulove.com/ratehack. Okay, so over here on this site, it's going to show you how you can take advantage of conventional loan rules to get a lower interest rate. And so basically what I did is I converted that chart that you saw before. Instead of it being LTV, I turned it into down payment, made it a lot easier to see. It's color coordinated. And then I explained here, what we're assuming is that on that other chart, a 0.5% cost, we're going to use an average of a 0.25% change in rate. Okay. So basically on what the other chart said was a cost, I converted this to a rate using averages. It doesn't mean it's going to be exact then, it's just going to be an average. Okay. So what we're seeing here is the potential rate change between two options. So this is how it works. So we're going to make up a theoretical interest rate to start with, okay? Because this chart is only showing us rate differences, the differences between two rates, we just want to start with something imaginary first. So let's say we're starting with a 7% interest rate. So with that 7% rate, we're going to look through here and see, okay, if you have a 700 credit score, and let's say you're considering putting 20% down. So with that 7% credit score, you're going to be looking at a 7.688% rate. Now, keep in mind, this is not what your rate is going to be. All I want to do here is show you the differences between two rates. So then let's compare that to you're considering working on your credit and improving it to a 740. Then it might be a 7.438, okay, 7.438. Now, all we're looking here is at the differences between these two, okay? Because a lot of people want to improve their credit and they're curious, how much is that going to change my interest rate by? And we can see that change going from a 700 score to a 740 score on average will give you a 0.25% better interest rate. That's the way that we use this chart. It is not going to tell you what your mortgage interest rate is going to be. Again, I'm just using 7% as an example so we can see the difference here in some close to real world numbers. Okay, so let's run through an example here based on a 700 credit score and if you change the down payment. So first of all, these are all estimates. You need an actual quote from a lender to compare these exactly. And if you are looking for a quote, you can always go to winthehouseyoulove.com, schedule a call with a mortgage advisor on our team. We work in all 50 states. So what we're going to do is we're going to run through an example of someone who's considering putting 20% down with a 700 score, which is a fairly common scenario. So what we're going to do here is look at our before option, and then we're going to look at two additional options here as well. So let's run over the strategy, and then I'm going to show you how to put all of this math together yourself to run your own scenario if you want to. So first, we're looking at the before option is putting 20% down, and then we're going to have a 700 credit score across the board, okay? Now, I'm projecting this rate here based on our rate hacking chart. So over here on the chart, I'm going to look for 700 credit score, and then I'm going to go over here to 20%. And again, just like we did for our example before, we're just going to put a fake number in front of it to make it easier for us to understand this math here. So we're going to put 7.688% as our projected rate. And then for our monthly payment, that's going to be $2,564. And the way that I'm finding this is by using my Loan Clarity Advisor calculator. So what this allows you to do is allows you to put in all of these numbers and calculates everything for you. So what we're going to do in our scenario is we're going to run through a $450,000 purchase price here. We're not going to worry about taxes and insurance. We just want to look at the loan itself. So when we're looking through this, just like on our chart over here, we're going to compare two other options. This first option is going to be 3% down and then 17% on payment number one. This is a really good strategy because it's going to take advantage of that loan level price adjustment chart. We're going to rate hack by actually doing a smaller down payment to get a lower rate, and then we're going to put the rest of the money on payment number one. So effectively, we're doing 20% down, but getting a lower rate, a lower projected rate of 7.348%. And then in option two, we're going to take a look and see, well, we could also potentially get a lower rate, the same rate as doing 3% down if we did 25% down. So let's run this all through the calculator and see how this math works. Okay, so again, we have before, we have option number one, which is going to be 3% down, and I'm just going to add in plus 17%, and then 25% down as well. Now, why are we doing that? If we go over here and take a look at the rate hacking chart, so on our 700 credit score level, if we're zooming across here, 25% is that 0.438 number. And then also 3% is that 0.438 number. So if I was in the position of doing 20% down, basically I have two options to get the lowest rate possible. I can either go all the way to do 40% down. That's probably going to be out of my range. Now I could do 30%. Again, that's stretching things. But what if I did an extra 5%, right? That puts me from 0.688% to 0.438%. Okay, so we get a little bit of a rate decrease if we bump up our down payment by 5%. Now that might be a stretch. So we could go the opposite direction and actually do 3% down and get the same rate as 25% down. okay? And we'll just add the extra down payment to payment number 1. Okay, so we're gonna put all of this into our calculator here. We have 20% down in option, our base option, then we're doing 3% down in our secondary option, and then we're doing 25% down in our third option here. So 30 years for each. I put in the interest rates here, 7.688, 7.438, and 7.438 as well. And then we're not worried about points or anything like that at the moment. So when you do less than 20% down on a conventional loan, you're gonna have mortgage insurance, okay? So you will have mortgage insurance. I'm gonna estimate that around $218 per month. Now, the nice thing is you're immediately gonna hit 20% equity, so you can actually request that mortgage insurance to fall off. Sometimes mortgage insurance might have a minimum duration of time that you have to have it on. Some lenders don't require a minimum duration. Some require 3 months, some require a year. You wanna check with your lender on minimum duration there if you're worried about that. So then what we'll do is we'll actually add an extra payment on this secondary option. And what we're gonna do is put a lump sum of that 17% on payment number 1. All right, so let's scroll through here and see what this does. Now, if we take a look at, let's say 5 years, the best option here is going to be 20% down. I'm sorry, 25% down is our best option. And as we actually continue this to maybe a more realistic time frame of how long you might be in a home, which 10 years is the average for most people, doing 3% down plus 17% on payment number 1 will save you about $30,600 over 10 years compared to the most expensive loan option, right? So if we look at this cost breakdown here, just in interest payments, we can see the interest payments between each of these. And then in our chart over here, I plotted out these differences as well. So you could go with this before option and do 20% down. That's perfectly fine. Or if you do option number 1 and do 3% down plus 17% on payment number 1, you're gonna get a lower rate to take advantage of that while still having the same amount of equity position. And that over 10 years will save you about $38,600. Or you could, if you wanted to, stretch a little bit higher on your down payment to save $24,888, okay? So both of these are some really solid options. One strong caveat being with this type of strategy is that when you look at the monthly payment, of course, when you do a lower down payment up front, that changes your monthly payment. So the lower your down payment, the higher the monthly payment is going to be. So if you are considering that, it's something to be aware of. This strategy is going to have a higher monthly payment than the other two options. 25% down is going to have the lowest monthly payment. Then you're going to have the 20% down, and then 3% down is going to be the highest monthly payment there. Now, I just walked through the tool that I use called the Loan Clarity Advisor, and the whole goal of this is to make sure that when you're picking a loan that you're not basing it off of a guess. Most people just choose a loan based off of, I guess this is what I think I should do, and I've heard 20% down is the best, so I'm gonna do that. And what this does is shows you real life math, the real life numbers that could save you thousands of dollars. And if you're interested in using this calculator, you can go to winthehouseyoulove.com/advisor. If you use the code Kyle, which is my name, you can save 20% off of it. And what it's going to do is you can compare any loan side by side, see the best option. You can compare FHA loans versus conventional. You can compare if you're going to pay discount points or not. You can compare different terms, different extra monthly payments, and see tons of different details about the loans that you might get. And you're going to get full transparency into your loan that loan estimates that lenders give you simply just don't show you. They're not going to be able to show you every single year what happens and how payments change and what changes with the total cost of your loan as well. And it fully calculates all of the mortgage insurance correctly and estimates it all the way that the rules and the guidelines are set up. So again, winthehouseyoulove.com/advisor if you're interested in getting that. Now let's go through another example. This is if you're getting a better credit score. So in this example here, what we want to do is instead of locking our credit score, we're going to assume you have a 700 credit score now, and we're going to lock the down payment. So maybe you're saying, I have a 700 score, but I can't change my down payment. 5% is really the best that I can do. So in that situation, we're going to again look at a 700 credit score, and with a 5% down, we're going to look over here, follow through over on the chart, and we're going to be looking at a projected rate of 7.563%. Okay. Now, option 2 is what if we actually increased our credit score by, let's say, 40 points to a 740? That tends to be the next target bracket that people go for. And then based on the chart, that would put us at a 7.313%. So then if we go over to the chart, we take a look at 5% down, and we're looking at the 740 range. So that would be 7.313% here that we'll use as an estimate. And then for our secondary option here is 780. 780 is actually the top of the chart for conventional loans. You can't get better than that and get a better rate. So that would put us at a 7.063%. Okay, so if I take all those numbers, throw them into the Loan Clarity Advisor, really quickly, same thing, all conventional loans, all 5% down, all 30-year terms, plugged in the different interest rates here. So of course, the higher your credit score is, the lower the interest rate is going to be. Okay, so now let's look at the results here. Let's look at again at a 10-year time frame here. So option 2 is going to save you $21,000. So that's pretty much a no-brainer here, right? Having a higher credit score is going to save you more money because you get a lower interest rate. But again, the question there is, how much is it actually going to save you? You don't want to just keep spinning your wheels building credit and not knowing what the payoff is going to look like. So over a 10-year period, option 2 obviously is going to be the best, having that 780 score. Having a 740 score is going to be $10,000 more expensive than having a 780. And then having a 700 score is going to be $21,000, about $22,000 more expensive over 10 years than having a 780 credit score. And then if we take a look at the monthly payment as well, you can see the differences here. Having a 780 score is going to save you about $145 compared to a 700 score. And then having a 740 score is going to save you about $72 a month compared to a 700 score. So if your main concern there then is your monthly payment, then having, spending a ton of time building your credit score isn't going to have a huge impact on your monthly payment compared to the down payment strategy. But over time, of course, over 10 years, over 14, 15 years, you're going to have quite a bit of savings by increasing your credit score. Now, if you are considering this strategy, I strongly consider that you use a credit simulator. And that's why I use ScoreMaster. You can get a $1 7-day trial at scoremaster.com/Kyle. The main thing I like about it here is it's going to show you how to actually simulate your score here. So it has a couple different tools. One, you can, of course, track your score. You can get a 3-bureau credit pull to take a look at your score. Also, it's going to help you take action with Score Builder to see what points you could add to your credit score. And then Score Boost is what I like because it shows you what payments could increase your score and then what spending can actually decrease your score. So from here, you can go into your account and then you can use this slider to see what points you need to your score. So for instance, if we were looking at going from a 700 to a 740, then we'd be looking at 40 points here. So it would show what the future score would be. This is just a demo account here. So the future score here, theoretically, we'd start at 700 and be to a 740. For this demo account, it's going from a 639. Okay, so looking at 40 points on the score, what it's going to do is show us how much it would cost to be able to get that score with this credit simulator. So we'd have to pay about $5,500. And then what it will do is actually show us a payment plan on credit cards. So it will show us what credit cards are going to change in points based on and how many days that's going to take to reflect that, the payment amount, when we need to pay it by, and when the credit score will be updated. So it gives you a whole plan here where I can actually say, okay, I know based off of rate hacking, this is how many points I want added to my score, and then actually create a realistic game plan here instead of just continuing to make payments and hoping that your score goes up. And I know this was a ton of information. Thank you for sticking around. If you are looking to get started or you just have questions, one of the best ways to reach out to us is to schedule a call with a mortgage advisor on our team. Everybody on our team has over 20 years of experience and would be perfectly capable of helping you. So you can go to winthehouseyoulove.com/lender. We work in all 50 states. What we can do is help you get pre-qualified or simply just answer questions that you might have so you can then start looking for homes. And then also, if you're looking for a realtor, you can go to winthehouseyoulove.com/agent. And so I partner with Home and Money, who is one of the largest real estate referral networks in the nation. And it's for a good reason, because they do a fantastic job at following up and making sure that you have clear communication, even if you're just wanting to use it as a second option or a second opinion for a real estate agent who can help you shop for a home.